Bismillahirrahmanirrahim. This talk provides a summary of the first few chapters of the book called House of Debt by Mia and Sufi. This book contains a detailed explanation of the global financial crisis of 2007. Our goal is to discuss the causes of the global financial crisis, but it's useful to begin with the background information about the Great Depression of 1929 because the two are amazingly similar in many ways. So what were the causes of the Great Depression of 1929? To this day, the controversy persists, and some leading economists have called this the holy grail of macroeconomic theory to find out these causes. Keynes said that it was due to the collapse of aggregate demand. Irving Fisher invented a theory called the debt deflation theory, which we will discuss briefly. And Milton Friedman said that it was due to monetary contraction caused by the collapse of the banking sector. In House of Debt, the book that we are discussing, Atif Mia and Amir Sifi provide empirical evidence that both Keynes and Fisher were partly right. The correct theory combines the aspects of both of them, and that Friedman is wrong. The Friedman theory is wrong. In previous post, we have covered the first three chapters, and this time we are covering the chapters 4 and 5 in this video. Classical economic theory is based on Say's law, which says that the supply will create its own demand. In particular, it says that in the labor market, you will always have full employment because whenever there is supply of labor, there will be people who want it at some price. The Great Depression showed that this was not true. A huge number of people wanted jobs at any wage, but they could not find them. So Keynes rejected classical theory and invented Keynesian theory, and he wrote this book, the famous General Theory of Employment, Interest and Money, which starts by saying that Say's law is wrong and that the unemployment will persist for a long time. And Keynes argued, basically the book was about trying to find out why this would happen. And basically Keynes argued that it is the collapse of aggregate demand which leads to unemployment, and that this is a natural feature, and that policy implication of this is that the free market will not correct this problem, so the government has to intervene and ensure full employment. Fisher also provided an important ingredient missing from Keynes, which was about debt deflation, which we will discuss later. Keynesian economic theory and policy led to a period of unprecedented prosperity in the West following World War II for about 30 years. This prosperity led for the a substantial increase in the wealth share of the bottom 90%, and correspondingly a reduced proportion for the top 0.1%. They didn't like this, so the rich and powerful plotted a counter-revolution. Details are given in the reference cited on Alkire and Ritchie, Winning Ideas. This counter-revolution was implemented in the Reagan-Thatcher era, where the Chicago School economics rose to the dominance and Keynesian ideas were rejected. The Chicago School put the supply side theories which had been rejected by Keynes back into place as the basis of economics. And Friedman rejected the Keynesian explanation and said that the Great Depression was caused by a monetary contraction, which was caused by the Fed allowing banks to collapse. And so what were the results of this monetarist counter-revolution, which was started in the Reagan-Thatcher era? One of the main thrusts of this was financial deregulation, which was completed by the repeal of the Glass-Steagall Act in 1999. This Glass-Steagall prevented banks from speculating, and this was removed. And then the Commodity Futures Modernization Act in 2000 created a whole sector of banking which was completely unregulated, and that's called shadow banking. Meanwhile, Robert Lucas in his presidential address to the American Economics Association in 2003, said that we have now solved the problem of prevention of recessions. This confidence of the neoclassical economists in the Chicago School theory led to ignoring warnings of upcoming crises, and there were the heads like Alan Greenspan and Ben Bernanke said that no, this kind of crisis cannot happen because the rational expectation said that if there was a crisis upcoming, people would foresee it. And so this crisis took the whole profession by surprise. Nobody had any clue as to it, as to the upcoming crisis. After the global financial crisis, again the policy response was shaped by Friedman's theories, and this led to quantitative easing, bailing out of the banks, and basically making sure that the money is flowing with no interference in the free market. These policies failed to prevent the Great Recession because of these wrong theories, and the harmful effects of this failure of economic theory continue to this day. Output was lowered and remains low, and the trend rate of growth was also lowered and remains low. So there has been enormous damage from the wrong theories which continue to dominate the profession. So the goal of this book, House of Debt, which we are studying in this lecture, is to explain why the supply side explanations, the Chicago School, the free market theorists are wrong, and to provide an alternative explanation for the global financial crisis. This is called the levered losses theory, and this theory combines Fisher's debt deflation elements and also the Keynesian theory of aggregate demand collapse. And the basic summary of the argument is that the weaker party or the poor people use $20,000 to buy a $100,000 house. This is called leverage debt. And the contract of interest-based is such that it puts all of the risk on the weaker party and none on the stronger party. So if there is a small collapse or a small decline in asset prices, if there's a small decline in housing prices, this wipes out massive amounts of wealth of the masses, the 90%, and this leaves them with huge debts. So this drives down aggregate consumption because these people have no money to buy, and they are also have to struggle to pay off debt and to rebuild the lost wealth in order to have savings for retirement. And this problem, which is basically at the heart of this, is the interest-based debt contract, and this can be solved if we go to Musharka contracts in which the risks of are shared between the two parties according to their strength. So the person who has more wealth gets to bear more of the risk. So that's the basic goal, and now we go discuss the details of this. So chapter 4 of the book sets out the levered losses theory. So there are two major questions that we will address. Why does the aggregate demand collapse? Keynes did not really have an answer to this. He just said that there is an external shock and this causes a collapse, and then the economy does not adjust. So this is the key. The second question is, why does the economy fail to adjust? According to neoclassical theories, if you have a shock which leads to unemployment, the economy will quickly respond and eliminate this unemployment. And basically Keynesian theory is about this failure to adjust. Keynes tried to show that low aggregate demand could persist for long periods, and this would lead to long periods of unemployment. And this was because people had lived through this era of post-Great Depression, where unemployment rates were very high and stayed very high for more than 10 years. So the first step in the Great Depression is a collapse in asset prices. Why did the housing bubble collapse? This is not explained in the book, but it is there is a detailed process, that mortgages were extended to more and more unqualified people for various reasons which are discussed later in the book. And as these people were not so qualified, so they started defaulting on mortgages. And when the default started, then the payments, these mortgages were bundled into securities called MBS, mortgage-based securities, and they were supposed to be guaranteed returns. But when lots of mortgages started collapsing, then the returns of these securities became much lower than had been predicted, and this led to the collapse of $1 trillion market based on these mortgage-based securities. And this market was actually feeding a lot of money into the mortgages, which is why people were trying to make lots of mortgage sales to unqualified people. So once the MBS market, the mortgage-based security markets collapsed, this dried up the money for mortgages, and this led to basically a crisis, a collapse of money was not available to buy houses, and that led to a collapse in housing prices. So when the housing prices collapsed, this led to wiping out of the wealth of the vast majority of households. These are the middle class households who had borrowed to buy houses. Basically, levered losses means that if there is a 10% fall in housing, this can wipe out 50% of your wealth because the amount of leverage that you have it works against you when there is a fall in prices. This was further magnified by the foreclosure externality. When houses are foreclosed upon, then the bank sells them in fire sales at very low prices, and this depresses the prices of the entire housing market. And a third effect was the distributional effect, because the fall in wealth was concentrated on the middle class, which is the major consuming class. So this created a huge fall in aggregate demand. If the losses had been to the wealthy, this would not have been so damaging. Similarly, because of the wipeout of the wealth, households try to build wealth back up for their retirement, which means that they shrink their consumption and try to increase their savings. So all of these effects lead to a collapse in the aggregate demand. So neoclassical economic theory is based on the idea that economies find their way to new equilibrium costlessly and quickly. So if there is an unemployment caused by a shock, the economy will adjust this and will eliminate this unemployment by free market mechanisms. So the chapter 5 of House of Debt explains why unemployment continues, why it's not eliminated, and why the mechanisms that are supposed to eliminate it do not work. So the book describes and explains and provides empirical evidence for a lot of frictions. These are obstacles to adjustment to a new equilibrium. There are 4 of them that we will discuss briefly. One of them is the lower bound of 0% on the interest rate. The second one is that wages are fixed in nominal terms and do not move downwards. The third is that laborers do not move from recession areas to better areas where they can find jobs. And the fourth is that when there is a collapse in aggregate demand, then demand shifts to other places. This requires changes in production, but these changes are very costly to bring about, and it takes a lot of time to shut down a factory and create a new factory for producing different types of goods. And the interest rate mechanism, which monetarists say will work, is that if the households lower spending, more money will emerge into the savings market, and this money will drive down the price of money, which is the interest rate. And when the interest rate is low, then investors will borrow this money and they will use it. So the lowered consumption will be compensated for by increased investment. The problem with this, already noted by Keynes, was the liquidity trap, that the interest rates, once they are low enough, they do not cause an increase in investment. If they get to 0, they cannot go further, And basically, if the investors do not want to borrow, then regardless of how much money is available for loan and regardless of the interest rate, they will not borrow, and so this mechanism will not work. And basically, investor borrowing doesn't depend purely on the interest rate. It also depends on their expectations about the future. If the future is bleak and the economies are going down, then they will not invest in the future. And there is a coordination failure here, that if all of the investors were to choose to believe that things will be bright and they started investing, then in fact this would become a self-fulfilling prophecy, because when they invest and they hire people, the people will get incomes and the future will become brighter. So there is a self-fulfilling element to this. So pessimism leads to bad outcomes. The empirical evidence cited by Mia and Sufi in House of Debt shows that wages remained fixed in nominal terms. They did not go down, even though there was a huge level of unemployment, which meant that there should have been downward pressure on wages. So there is a huge literature on this topic of wage rigidities. Basically, Hicks and Samuelson misinterpreted Keynes to say that Keynes was talking about fixed wages, and that's why there is no equilibrium in the labor market, because the wages do not go down. In fact, that's not true. Keynes said that this would work, that the unemployment would persist even if the wage goes down. And the debt deflation theory of Irving Fisher explains why this is true. Basically, if you have cuts in wages, then the firm's costs go down and they can lower their prices, and will do so in a competitive market. But when wages are reduced and prices are reduced, then the debt burden increases because the real value of debt increases. So the workers want to work even harder, meaning that there is even more excess supply. So the going down of wages does not reduce the supply of labor, it actually increases the supply of labor, and this creates a vicious cycle. And there's a lot of empirical evidence for these mechanisms of debt deflation. Finally, there are huge difficulties in transition to a new equilibrium that is required by this collapse of aggregate demand. You have to shift your production to other sectors, you have to produce for exports, or you have to produce for the richer segment of society which has not had its wealth destroyed. But this requires a change in types of goods, change in factories, change in training of the retooling and retraining, new types of factories and new types of skills. In addition to this problem, we have that laborers are attached to their communities and they don't want to move. So there is a lot of evidence presented that even if you had a very high unemployment in one county, laborers would not move from that county to places where unemployment was lower. So again, this causes obstacles to the elimination of unemployment. Basically, the problem lies not so much with the real world as with the mindset of the economist, who automatically assume that there are no frictions and there will be costless and quick transition to a new equilibrium. This does not happen in the world, and the theory, because of this false theory and false theoretical mindset, economists ignore the disequilibrium dynamics and the huge cost of the transition. And these costs have been computed that a worker who loses a job loses income equal to 3 times his annual pre-layoff earnings over their lifetime, and this is a huge loss. In addition, there are social losses, depression, loss of dignity, divorce, and these are not so easy to calculate in monetary terms, but they are quite devastating in human terms. So basically, Mia and Sufi conclude that these problems cannot be fixed after the onset of levered losses. After asset price collapses and wealth is wiped out, then you can't fix the problem. So the solution is to prevent this from happening. And to prevent this from happening, basically we have to eliminate the unjust interest-based mortgage contract. And this is very much in line with Islamic principles. Islam says that the person who is earning money on wealth is doing so because he takes risks. So the Musharaka contract shares the risk according to the capital shares. So if the household puts up 20,000 and the bank puts up 80,000, then the risks should also be shared in this proportion, 80 to 20. And once you do that, then actually it can be shown that the global financial crisis would not have happened if the mortgage-based contract had been replaced by musharaka contracts. So the harmful effects of debt have been documented in great depth by Graeber in Debt, the First 5,000 Years. So Islam provides a very clean solution to these problems.